The silver market did not ease into the end of this year. It lunged. In the final weeks of December, silver pushed into territory that, for decades, had existed mostly in charts, footnotes, and long-forgotten inflation-adjusted comparisons. Prices surged toward the low 80s per ounce before pulling back slightly, and that pullback did nothing to calm the underlying tension in the market. What matters is not the intraday retreat, but the scale of what already happened. From the start of this year to late December, silver climbed by nearly 180%, a move that forces even seasoned market participants to pause and reassess what kind of market they are actually dealing with now. This is not a typical commodity rally driven by a single headline or a short-lived speculative frenzy. In the final days of December, silver briefly traded above $80 per ounce, a level that instantly reframed conversations across bullion desks, coin shops, and futures exchanges. For comparison, silver spent large parts of the previous decade struggling to hold levels in the high teens and low 20s. The psychological shift from "will it ever break 30" to "can it sustain above 80" happened with astonishing speed. What makes this moment different is the widening disconnect between the way silver is priced on screens and the way it behaves in the real world. Futures contracts continue to set the headline number, but physical metal is increasingly governed by scarcity, logistics, and immediate demand. Reports released within the past week highlighted sharp price volatility following margin changes on U.S. futures exchanges, underscoring how fragile paper pricing has become when confronted with real stress. This is the backdrop against which the rest of the silver story must now be understood. A market no longer creeping upward, but lurching forward under structural strain. Inside the physical silver market, the rally has felt less like a celebration and more like controlled exhaustion. Coin shops, bullion dealers, and wholesalers are not describing crowds driven by social media hype or first-time speculators chasing headlines. Instead, they describe something quieter and far more revealing: continuous transactions, steady foot traffic, and experienced buyers and sellers operating with urgency but not panic. Dealers repeatedly report days where buying and selling never pause, not because lines stretch out the door, but because inventory turns over so fast that the counter never goes quiet. What has changed most dramatically is the availability of physical metal. Over the past week, reports from Asia showed physical silver trading at premiums of $7 to $8 per ounce, above futures prices in Shanghai, a rare and telling signal of tightening supply. That premium is not driven by collectibles or novelty products, but by immediate industrial and investment demand competing for deliverable metal. In practical terms, it means buyers are willing to pay well above paper prices simply to secure ounces that can actually be delivered now, not promised later. At the same time, wholesalers in the United States and abroad are quietly rationing supply. Orders that were once filled within days are now delayed, reduced, or rejected outright. Dealers describe situations where constitutional silver, generic rounds, and standard bars are unavailable in quantities that would have been considered routine only months ago. Refiners, who had previously stepped back from buying scrap and 90% silver, have returned to the market but under strict limits, capping how much metal they will accept each week. This is not normalization, it is damage control. Perhaps the most revealing detail is how dealers are responding to these pressures. Many are buying physical silver below the published spot price, not because demand is weak, but because replacement risk has become extreme. If metal cannot be easily replaced, every purchase becomes a balance sheet decision rather than a simple transaction. Analysts tracking paper to physical ratios now estimate that more than 350 paper ounces are claimed for every single ounce of deliverable silver, a figure that would be dismissed as theoretical if it were not increasingly reflected in real-world shortages. The result is a market where physical silver behaves less like a commodity and more like a strategic asset under stress. Pricing signals are fractured, supply chains are strained, and trust in paper representation continues to erode. This is not a temporary inconvenience. It is the foundation of the current silver environment. As prices surged, something counterintuitive happened across the silver market. Premiums did not rise uniformly. In fact, in several segments they collapsed. This contradiction sits at the center of the current confusion surrounding silver and exposes how distorted the market structure has become. On one side, buyers in Asia and parts of Europe are paying aggressively above futures prices just to secure immediate delivery. On the other, certain forms of silver in the United States are trading at or even below spot, not because demand vanished, but because liquidity and replacement risk are dictating behavior. In the past, high spot prices almost always translated into higher premiums across the board. That relationship has broken down. Over the past several days, dealers have reported that some forms of 90% constitutional silver are being sold under spot, a scenario that would have been almost unthinkable during previous bull markets. The reason is not a lack of interest. It is the sheer volume of metal being liquidated by long-term holders who are finally seeing prices they never expected to see in their lifetimes. When supply floods in at once, premiums compress, even in a rising price environment. Numismatic and semi-numismatic silver has been hit particularly hard. Coins that once commanded sizable premiums based on collectability are now being priced almost entirely on metal content. Recent market data show that several government-issued silver products are effectively trading as raw bullion, their historical or aesthetic value temporarily erased by the speed of the price move. This is not a judgment on long-term value. It is a reflection of what happens when spot prices run so far, so fast, that they overwhelm secondary pricing structures. At the same time, premium compression is not universal. In markets where physical availability is tight and industrial demand is immediate, premiums have expanded sharply. In Shanghai, physical silver premiums recently widened to levels exceeding $7 per ounce above futures, highlighting a regional imbalance that paper markets are struggling to reconcile. The same ounce of silver is being discounted in one location and bid aggressively in another, depending entirely on proximity to supply and the urgency of demand. This divergence exposes a deeper truth about the silver market. Premiums are no longer a simple indicator of demand strength. They are a signal of stress, location, and timing. In one sense, collapsing premiums suggest abundance. In another, soaring regional premiums point to scarcity. Both can exist simultaneously, and right now they do. For investors and dealers alike, this is the most dangerous phase of any commodity cycle. When familiar signals stop behaving the way they used to, and old assumptions quietly stop working, the tension between paper pricing and physical reality became impossible to ignore when the futures market tried to regain control. In mid-December, the exchange raised margin requirements on silver contracts, a familiar move with an equally familiar justification. Volatility had become excessive. The immediate effect was dramatic. Silver sold off by roughly 11% intraday, following the margin increase, triggering forced liquidations among leveraged traders, and briefly restoring the appearance of order on trading screens. To casual observers, it looked like the rally had been checked. To anyone watching closely, it looked like confirmation that the system was under strain. Margin hikes are often described as neutral risk management tools, but history tells a more complicated story. A single increase can cool speculation temporarily. Multiple increases in quick succession are usually required to break a sustained move. What matters is not the first reaction, but what happens afterward. In this case, silver stabilized quickly, refusing to collapse despite the sharp shock. That resilience mattered. It signaled that selling pressure was largely mechanical rather than conviction-driven. Market commentary released within days of the margin hike emphasized growing concern about liquidity rather than price direction, a subtle but important distinction. When exchanges tighten requirements, they are not expressing confidence. They are responding to stress. Volatility at this scale does not emerge in calm, balanced markets. It emerges when positioning becomes unstable and when too many claims exist on too little deliverable material. At the same time, broader financial forces added to the strain. A strengthening dollar encouraged short-term profit-taking, while year-end positioning amplified swings as funds locked in gains. None of these factors addressed the underlying issue. They merely altered the tempo of the move. Beneath the surface, physical demand remained firm. Industrial buyers remained active, and dealers continued to report difficulty sourcing metal in size. Perhaps the most telling development was not what futures traders did, but what they did not do. Despite the margin shock, there was no sustained rush to abandon silver exposure altogether. Instead, leverage was reduced while exposure remained. This is a critical distinction. It suggests that participants are adjusting how they hold silver, not whether they hold it. The futures market can slow price advances, but it cannot manufacture physical supply. Each intervention buys time, not resolution, and time is precisely what a structurally tight market lacks. The margin hike did not end the silver story, it clarified it. What ultimately separates this silver rally from so many that came before it is not speculation, monetary fear, or even inflation expectations. It is demand that does not care about narratives. Industrial consumption has become the immovable object in a market that has historically relied on investment flows to explain price moves. In recent weeks, that reality has started to surface more openly, and it is forcing uncomfortable conversations across supply chains that were never built to handle sustained scarcity. Silver is no longer a marginal input quietly absorbed by industry. It is embedded in solar panels, data centers, advanced electronics, medical equipment, and defense systems. And those uses are not discretionary. Recent commentary surrounding China's upcoming export controls, set to take effect on the first day of January 2026, underscored how strategically sensitive silver has become, not just as a commodity, but as an industrial necessity. When a country begins to regulate the outward flow of a material, it is an implicit admission that domestic demand is colliding with limited supply. That collision is already visible in inventories. Exchange-tracked silver stocks in Asia have fallen to levels not seen in nearly a decade, and replenishment has proven slow even as prices surged. Unlike gold, silver is consumed. Once it is fabricated into panels, circuitry, or specialized components, it does not immediately return to the market. Recycling exists, but it lags price signals by years, not weeks. In the short term, supply is effectively fixed. Within the past several days, industry analysts warned that elevated silver prices are beginning to ripple through manufacturing cost structures, particularly in sectors tied to renewable energy and high-density computing. This is not hypothetical pressure. It is showing up in procurement decisions and contract negotiations now. Higher prices do not destroy this demand. They merely shift it forward as buyers race to secure material before costs rise further or availability tightens again. In the United States, the designation of silver as a critical mineral has added a policy layer to what was already a logistical problem. That classification does not immediately create new mines or expand output. It signals priority. It tells manufacturers, investors, and foreign suppliers that silver has crossed a threshold from optional input to strategic resource. Markets tend to respond quickly to such signals, even when supply cannot. This is why comparisons to past silver rallies fall short. Earlier cycles were driven largely by investor psychology and monetary fear. This one is being reinforced by industrial necessity. Price volatility may scare off leveraged traders, but factories do not hedge by walking away. They hedge by buying early, buying more, and locking in supply wherever possible. That behavior does not make headlines, but it reshapes markets from the inside out. As silver pushed into price levels once considered extreme, forecasts inevitably followed. Some were cautious, others aggressive, and many recycled numbers that had floated around the silver market for decades. What matters now is not the headline targets themselves, but the reasoning behind them. In recent days, analysts and market participants have increasingly framed silver's trajectory not as a straight line higher, but as a series of stress tests imposed on a market already running near its limits. Short-term projections have clustered around the $70 range, largely because that level aligns with historical gold-to-silver ratios, normalizing from extreme distortions. From there, attention shifts quickly to the psychological threshold of $100 per ounce. Several recent analyses published within the past week argued that a move toward $100 in the coming year would not require speculative mania, only continued structural deficits and steady industrial demand, both of which are already present. This is an important distinction. Markets driven by fundamentals behave very differently from markets driven by euphoria. Longer-term comparisons introduce even more uncomfortable math. Adjusted for inflation, silver's previous peaks imply levels well above $140 per ounce. That figure often sounds sensational until it is placed alongside gold's own inflation-adjusted performance over the same period. Gold has already reclaimed and exceeded its real historical highs. Silver has not. Whether it does is less a question of desire than of availability. Price, in this context, becomes a rationing mechanism rather than a valuation metric. At the same time, responsible forecasts acknowledge the risks. Sharp pullbacks remain likely. Volatility is no longer an exception. It is the defining feature of the market. Strong dollar moves, margin interventions, and profit-taking can all produce violent corrections without altering the broader trajectory. Recent market commentary emphasized that these drawdowns are increasingly being met with physical buying rather than capitulation, a behavioral shift that would have been rare in earlier cycles. What this suggests is a market transitioning away from fragile optimism toward conditional conviction. Participants are not betting blindly on upside. They are positioning around constraints. Silver does not need universal belief to move higher. It only needs continued imbalance between what is promised on paper and what exists in vaults, warehouses, and refineries. So far, there is little evidence that imbalance is easing. Forecasts, then, become less about predicting a specific number and more about acknowledging uncertainty within tight boundaries. The range of outcomes is wide, but the floor keeps rising. In markets like this, restraint often matters more than enthusiasm, and patience becomes a strategy rather than a virtue. The silver market is no longer behaving like a side story to gold or a speculative playground for traders chasing momentum. It has become a pressure point where monetary policy, industrial demand, supply constraints, and financial engineering collide in real time. What began as a price breakout has evolved into a test of how modern markets function when paper claims multiply faster than physical resources can respond. The defining feature of this moment is not price alone, but friction. Friction between futures and physical metal. Friction between industrial buyers who cannot substitute silver away and financial players who can exit with a keystroke. Friction between exchanges trying to manage volatility and dealers trying to source inventory without exposing themselves to replacement risk. Each of these pressures would be manageable in isolation. Together, they form a system that feels increasingly stretched. Silver's role as both a monetary hedge and an industrial necessity makes it uniquely vulnerable to this kind of strain. Unlike assets that exist purely in financial form, silver must ultimately be delivered, fabricated, consumed, or stored. That reality imposes limits that leverage and derivatives cannot erase. Recent data showing persistent structural deficits, declining inventories, and elevated regional premiums reinforce the idea that this is not a transient imbalance, but a cumulative one. Every month that demand exceeds supply tightens the system further, even when prices temporarily retreat. For investors and observers alike, the lesson is not to fixate on daily price swings or round number targets. It is to recognize that the market is signaling something deeper. When exchanges intervene, when premiums fracture, and when industrial users begin competing directly with investors for material, the price becomes a symptom rather than the cause. Silver is being repriced not because it is fashionable, but because it is scarce where it matters. Whether this tension resolves through higher prices, demand destruction, or long-term supply expansion remains uncertain. What is increasingly clear is that the old assumptions about silver, its availability, and its behavior no longer apply. Markets adapt slowly, and when they do, the adjustment is rarely smooth. Thank you for watching, and if you have thoughts on where the silver market is heading from here, feel free to share your perspective in the comments below.